Well, hello and welcome to Rajya Sabha TV. You're watching Discussion Today with host Rajat Kane. Well, in this episode, we'll discuss RBI's Financial Stability Report, which reflects the collective assessment on risk of financial stability and the resilience of the financial system. Now, this report has several indicators and, of course, several findings. Among the salient points, the report concluded tepid credit growth but surge in the deposits, reflecting precautionary savings in the face of high uncertainty. Macro stress test for credit risk show that scheduled commercial banks cross non-performing assets, or the NPA ratio may increase from 7.5% in September 2020 to 13.5% by September 2021 under the baseline scenario. Well, the stress test also indicate that scheduled commercial banks have sufficient capital at the aggregate level, even in severe stress scenario. But at the individual bank level, several banks may fall below regulatory minimum stress if aggravates to severe scenario. So what does this report say about the financial environment in general? To discuss further on this issue, we are joined with panel of two important experts. Well, Dr. A.K. Sharan, he's Professor AJNI-FM, and Mr. Ashok Kumar Jha, he's our former Finance Secretary, the Government of India. Well, many thanks for joining us, sir. Let me start with you, Mr. Jha. Given the RBI's Financial Stability Report, what are the broad indicators that you deduce from this recent report?
Well, I think, firstly, this report is on expected lines. Because after all, the report is basically projecting the situation from September 2020 to September 2021. Now, the fact that the gross NPAs of the banking sector is going to go up is not a surprise at all, considering that growth in the first half of the financial year 2021 has been negative. So therefore, when the report says that the gross NPAs are likely to increase to 13.5% or 14.5%, or or for PSBs that it is going to increase to as high as maybe 17%, is, as I said, on expected lines, because there has been a very bad financial situation in the country because of the pandemic. Also because the fact that a lot of forbearance was given by the RBI during this period. So a lot of the loans which so far have not been accounted for in terms of looking at whether they are being serviced or not. Those loans will now ultimately, when the forbearance gets lifted by March next year, then a lot of these loans will obviously become NPAs because of the difficult economic conditions in the country during this period. The other, I think, important point the report makes is about capital adequacy. That a lot of banks will obviously fall below the minimum capital adequacy norms and will therefore need to be capitalized. In fact, the report talks about at least 4 public sector banks which will not be able to adhere to the capital adequacy norms, and that this number could go from 4 to even 9 public sector banks, depending upon the kind of stress that we assume that will happen. So, all in all, I think it is basically a pointer to the fact that the economy would have gone through a stressful period, and that the banks need to be very careful and to make sure that they are recapitalized as and when the time comes.
Well, that's very important points that you've made, Mr. Jha. And so clearly now Dr. Sharon, moving on to, discussing it further. So, what is your takeaways from these report? Say broadly speaking, let's begin with dissecting report. Let's say first point the NPA, the rising NPA. What is your takeaway in the report? Is it, per you, it's also on the expected lines, given a very distressful past financial year?
I would say I totally agree with Mr. Jha that NPAs in the coming years, once you stop the supervisory forbearance,
Right.
it's quite likely that the NPAs would be on the higher side
Right.
for many reasons. I mean, the reasons could be many, but one thing is, as a matter of fact, the NPAs will be on the higher side because as long as, if you see the credit to deposit ratio, the deposit ratios have obviously increased, but the credit has not taken off much. So
Right.
in view of that, whatever credit already has been given to the producers, to the other sectors, that becomes NPA and no fresh credit is encouraged by the banks because of their own internal conditions, because of their own framework of capital adequacy. So the new NPA, the new assets, if the new the assets are not coming up and the older assets are getting degenerated, it is
Right.
definitely going to result into some kind of a higher elevated
NPAs.
stage of the NPA. So
Yeah.
that is for sure. Another thing which I picked up from the narrative of Mr. Jha, which is again correct, and I also have the same opinion to tell you, that the conditions, the financial conditions of the public sector banks, leave aside the private sector, because many private sector banks have borrowed also from the market to meet to these capital adequacy and all other requirements. So they are not as such in any condition to meet these requirements. But the public sector banks also, if the regulator support or the government support is not with them, I don't think their risk appetite is going to improve any further. And therefore, we'll have to see the risk propensity vis-a-vis the risk appetite of the public sector banks. And given the present scenario, at one stage, even the governor remarked that the public sector bank per se, in general, it was a subtle remark, that they do have an inefficient risk management system. And as a reason, they will not like to take the fresh risks. So if they don't take the fresh risks, assets are not created, it's very likely that the NPAs will definitely mount. I mean, they'll proceed northwards. So the challenge is for the banks now to contain their NPAs to the lowest possible, whatever they can, because it is projected by the sector experts that it will take a lot of time. If you go by the raters, the international raters, they themselves have suggested that the banking system will take a lot of time to cover up, and NBFCs will take even longer time. So therefore, I'm only confining to the banking sector, because the banking sector, if I'm not wrong, my understanding, they generally form 2/3 of the entire financial system. So 2/3 of the financial system, if they are stressed assets, they have stressed assets, and they go by the same pace in management of their assets, provisioning ratio also, I mean, if it has improved, it's a very temporary measure. So I would like to conclude on this note that the most care seeking area is the NPA management, and if we are not taking it up with some interventions, the NPAs are definitely, because how long will you reschedule the loans? How long? That is no solution, permanent solution. So yes, we have to be careful, and I will not say it is on the expected lines, because my expectations would have been different, but this report is definitely on the honest lines.
Right.
That's
Well, that's very important point, and broadly understanding. Now it's as you said, that how far you can stretch the loans. Yes, Mr. Ashok Kumar Shah. So clearly, like NPA management is one thing. Now, another thing that is a part of report is there is a decline in the credit, whereas there is surge in the deposit. What does that indicate for a broader economic or financial ecosystem? Is there some sort of a conservative deposits or savings by the consumers in general?
You see, the decline in credit was there even in the last financial year. Credit growth in the previous financial year was less than 6%. when we didn't have the ravages of the pandemic.
Right.
Now, it is expected that the credit growth during the current financial year will be not more than 1%. This is an estimate that CRISIL has made. Now, so therefore, the fact that the credit growth is going to be low is again very much expected because economic activity ground to a halt in the first quarter and started really moving slightly sluggishly in the second quarter. So the credit growth is going to be low. That is again, as I would say, again on expected lines. The reason for the higher deposits is because people were obviously they didn't have avenues of investment or avenues of expenditure, so the banking system went up, and that is again to be expected. I suppose what I would say was slightly unexpected was the fact that the credit growth is only supposed to be 1%. I would have expected a credit growth of at least 3 to 4%. But anyway, this is only an estimate at the moment. It's we don't only know what the credit growth is at the end of the financial year. The basic point is that if the economy starts picking up, there's been a slight uptick in the third quarter. Hopefully, in the fourth quarter, it will move up even more briskly. So, if the economy starts moving up, then there is a good chance of credit growth to also go up. There is a good chance that maybe as a result of that, it will have a favorable impact even on NPAs. The other point that I think is worth looking at is the fact that, which even RBI has pointed out in its report, is that there has been a very large sort of asset price increase.
Yes, absolutely.
Whether it's assets, basically they're referring to the stock market, the equity market, even the credit market, the debt market. Now, this is absolutely unconnected with the real financial sector, with the real economy, because as we've just discussed, the economy is not moving so rapidly, but the stock markets are booming. Now, quite obviously, this boom in the stock markets is creating this problem of asset prices being very unreal. And this is being fueled mostly by international funds. See, money from abroad, because most of the countries abroad, Western countries, they have put in place a very, very heavy dose of monetary easing. So whether it is the United States of America, whether it is Europe, whether it's Japan, they're pumping in a lot of money in their systems, and some of that money is coming to emerging markets, including India. And that is what is basically playing up the prices here, the asset prices here. Now, this sort of mismatch between what is actually happening in the economy and where the financial assets prices are can cause some problems unless it is recognized and unless there is an effort to basically rein it in.
Right. That's a very important point. Dr. Sharan, just carrying forward to what Mr. Jha said, so asset pricing, valuation, and of course, which is there in the stock market, what are the ways to have a better check on that? And do you also think it's also leading towards a sort of a mismatch, Dr. Sharan?
It is. It is definitely, because if you talk as correctly pointed out, because the two economists will almost speak the same language, the real sector of the economy, it goes by the fundamentals, and the financial sector, that's the secondary market, the stock exchanges and all, they basically move on the speculations and some kind of pumping in. So obviously there has been a disproportionate growth of the stock markets, and it doesn't reflect anyway the growth of the real sector of the economy. So the issue is that valuation and as it is pumped in, and there may be other players also who would be interested in the higher valuations of the financial assets. But the larger issue is because we are kind of addressing the issue of credit growth. The stock market growth and other kinds of things would be okay. But the credit growth to take up, I think the real boosters would be some kind of initiative in the form of other policy than merely the monetary policy of the government of India, the Reserve Bank of India, or the financial stability report. So to boost the credit, you will require definitely new takers and new appetite for the credit. So these could be either startups, or these could be either the healthcare sector, or these could be otherwise the hospitality sectors, which now need to be given more boost. So once the booster goes there, because the traditional sectors, they'll not pick up till and until the economy reaches a level, because crowding in, crowding out, you also and we all understand. The other issue which I would like also to highlight here is that once the COVID vaccine is largely in place, that will work as a big CBM, confidence building factor or measure. And my expectations would be, once we get out of this fear of this COVID, the economy will expand in the form of more expenditure and more investments. That is still needed, because this parked money from East Asian and other economies is not going to build any confidence in the minds of the producers. So real sector to boost up will require different measures, and those measures will have to be in the form of some kind of an initiative, in the form of some kind of a policy of the government of India. And that policy for the production sector has to align with the financial measures or the regulators' outlook and other things. That will possibly, because one or two things which I will suggest with you, that if you talk about the systematic risks of the banking sector, till and until the systematic risks for which there is a perception that they are on the higher side, the banks, if they don't find, they won't like to change their portfolios that easy. And if their credit portfolio doesn't change, then definitely the NPAs are not going to be any lower. So my view will be that the valuation of the financial sector has to be a little more on the realistic side rather than on the speculative side. And somewhere as a measure of policy, because if you look at the FDI inflow, on which sometimes back we had a debate, the FDI inflow when it came, and it is one of the largest chunks that we received, it didn't find a place in the production. It all went to the equity side. Right. So this kind of a money coming in is basically finding some kind of a convenient or a safe parking. It is not resulting into augmenting of the productive capacities. So till and until the productive capacities are addressed, I don't think the credit size is going to change any further. And then the banks will have their own assessment. They will have a framework for risk management. They will have a framework for immediate attendance to certain factors. But if you look at the liquidity, if you look at the profitability, you look at the capital adequacy, you look at the other spreads, banks are not at present in a very comfortable situation. Their comfort will only come from the economy having a confidence that they have gotten out of this pandemic, and which, in my opinion, limited personal wisdom, I would say that once the vaccination starts and it spreads across the country, that will give some kind of a confidence to the producers and consumption, the takeoff. Because it's very clear that if you have a deposit surge, it means either the investment or the expenditure is on the backseat.
Right.
So to expenditure to increase, the economy will have to produce more, and economy will only produce more once the producers are confident that their production will be taken good care. So I'm not trying to get into the traditional macro economy, because we are now talking the macro tests and all. But the aggregate demand will boost shortly after the COVID thing is in place.
Well, that's important, Dr. Sharan. So, Mr. Jha, I mean, as you mentioned that our credit issue with the bank was existent even prior to the pandemic had set in. But now, with the uptick of economic activity or more consumer activities, will that be some sort of an improvement for the banking sector, as it's pointed out that banking sector seems to be stressed, fairly stressed, given at this scenario and given the macroeconomic indicators?
Go ahead if you want to. Yes,
I
go
would
ahead.
say that it was very rightly pointed out that the manufacturing sector's performance pre-COVID was at its lowest bottom, perhaps.
Yeah.
So even at that time, but in the system, in any economic system, you have periodic ups and downs. So that was the reason for the stress of the economy.
Right.
Post-pandemic, what happened? That only added fuel to what was happening earlier. So now you have to take the gross picture, that reasons for the slowdown of the manufacturing sector, because manufacturing sector has to be addressed first. You leave aside the services, they will align with the manufacturing automatically.
Right.
So manufacturing sector has to be addressed first, and for that the manufacturers will need a confidence that their production will be consumed. So some kind of a business cycle fluctuation or some kind of an interim fluctuation is one thing, but that has been aggravated disproportionately. It is quite likely that the slowdown would have recovered in the natural course had the pandemic not been there. But the pandemic deprived us all the opportunities to recover faster. And that's the reason. So now we'll have to take a gross picture, what we were pre-pandemic, what we are during pandemic. So if we factor in or factor out the pandemic, then we'll have to look again back to the fundamentals as to what can boost the credit of the banks. This is my take. Now, Professor Jha,
just to continue with what Professor Sharan was mentioning. Now, if we look at the economy in the last 3-4 years, you take the growth in the last financial year before the pandemic hit us. The last financial year, the GDP growth was about 4.2%.
Yes.
The year prior to that, the GDP growth was 6%. The year prior to that, it was 7%. The year prior to that, it was about 8%. So basically, for the last 4 years, the economy has been slowing down. Well before the pandemic. Pandemic, of course, made situation so much worse that you had a negative growth in the first quarter and even a negative growth in the second quarter. So essentially, the point I'm trying to make is that, we have been in this country, we have been going through a period of lower and lower rates of growth for various reasons. That's beyond the scope of our discussion today. Now, in order for us to, and you see, whenever there is a lower, the rate of growth slows down, the financial sector gets affected first.
Yes.
Because it is the financial sector which basically provides the lubricant for the economy to grow.
Yeah.
And if the growth is not there to the expected level, then your NPAs will rise and all the other, the adverse impacts take place. So we all expect and we hope that once the vaccination rollout is done, people are vaccinated, the economy starts moving up, and then you will have, with the higher rate of growth, automatically the NPAs will start coming down, your capital adequacy will improve. So all these are interconnected. And the fundamental driver for all this is really economic growth, the GDP growth, which we hope, if since this financial year is almost over, at least from next financial year onwards, it will start on a new slate. The only one point of caution that I would like to highlight is that some of the types of loans that are being given by the banking sector are likely to result in higher NPAs.
Okay.
For instance, I was looking at a report the other day of the State Bank of India was saying that its percentage of NPAs out of mudra loans is as high as 20%. So now, if this is not looked at very closely, then it can cause a fresh bout of high NPAs, and which can impact the banking system very adversely.
Right.
What is said by the expert, Mr. Jha, it has a reason. the last 4 years slowing down of the economy, if we see, one is the fluctuation as we normally have. Another thing is whenever you have policy reforms or whenever you have governance reforms, that also is responded to by the industry in some kind of a resentment or some kind of an acceptance. So possibly the policy reforms, because we see amidst the slowing down of the economy also, we received some kind of an appreciation from some international raters also that the policy perspective is in place. And when you change that perspective, it again takes some time. It is but for the COVID that we would have taken off. It is but for the COVID that we have not been able to take off. It would not have been possible that 8, 7, 6, 4, 3, 2, 1, it would have gone like that. It wouldn't go like that because there is some kind of an arrangement. We don't go by the other facts. But this situation is not likely to continue for a long time. Only addressing factor would be that the banking requires two sets of immediate interventions. Who will do that? Whether that is desirable or not in the era of Basel compliant economy, that banking sector, two interventions are required, that the banks are no specialists of variety of sectors. Having been a banker myself, I can add to it that when the projects are appraised, consortium arrangements could be there or other arrangements. So there is one sector that the banks will need specific specialization if they are moving to different sectors. Second thing is that the directed lending, as Mr. Jha also said, the mudra loans or all kinds of loans, if the banks are too much pressurized with the directed lendings, you don't have a bright scenario for the public sector banks in terms of their getting out very easily from their size, the basket of the NPA. And I go by the earlier Narsimham committee reports or all reports when an 8-fold classification was converted into a 3-fold classification. It did a lot of improvement, but then that also surged. So my contention goes well aligned that whenever you have a policy reform, you will always find that the picture initially deteriorates and then takes off. So my expectations would be that the credit boosting will be done with some kind of a management of the risk framework. Or even the RBI, what they have prompt corrective action framework, PCA framework, RBI also will have its own way to deal with the problem. But generally, the scenario.
Well, many thanks, Dr. Sharan, and many thanks, Dr. Ashok Kumar Jha, for elucidating on the salient points of the report and also the findings. And of course, what is a way ahead for improving, or to say, not just the banking sector, but also uptick in the economy and how it will aid our financial system. Well, that's it in this edition of Discussion Today. Keep watching Rajya Sabha TV for more. Thank you and goodbye.